Hello, everybody, and welcome to the latest episode of the Sharesify podcast. I'm joined, as usual, by my colleague and friend James Crux, and we are delighted to welcome our surprise guest is Emma Bird of Winterflood. Hello, Emma. How are you?
Hi,
Emma.
good, thank you. Thanks for having me.
Just give us the quick rundown then of what Winterflood does and your role within the organisation.
Sure. So Winterflood as a business is a market maker, so providing liquidity for trading various instruments, primarily equities. And then within that, there's an investment trust business, which essentially has a kind of mini investment banking model. And within that, I head up the investment trust research team. So we produce research on individual investment trusts as well as the sector in general. Historically, that has been for professional investors only, but in the last few years, we've actually launched a new product that's available to individual retail investors.
Yeah, I mean, it's an interesting area, investors, because they've always been very popular with retail investors. Let's turn to one of the more popular ones, or until recently. So Smithson has gone through this process, or they're going through the process of converting from an investment trust structure to an open-ended investment company, or OIC. Now, this has been met with mixed reviews, to say the least, and it looks like quite a lot of their shareholders are going to exit, and rather than that, I just wonder what you feel in terms of the structure between the two. Is the advantage of being an investment trust over an OIC, especially as most investment trusts are, they're invested in liquid listeds?
Yeah, so I think there are a number of advantages of investment trusts over OICs, as you might expect me to say as an investment trust analyst. Clearly, a big one is the ability to invest in less liquid or illiquid assets, whether that's private equity, real assets like infrastructure or property, or even just less liquid listed equities like small caps.
Yeah.
But there are other advantages as well. So they can utilize gearing to enhance returns or income. They can, unlike OICs, they can keep up to 15% of their income in each financial year in reserves, and they can use that to smooth dividend payments in years where that's needed, which we saw was a big benefit during COVID, for example. And the permanent capital structure can also just help maintain a long-term view for the fund manager. They don't need to deal with inflows and outflows. And kind of what you alluded to with Smithson, another advantage is that the investment trust has an independent board. So it's independent of the manager. They can propose a management change, a wind down, such as this example, a merger, or a strategy change. So obviously in Smithson's case, the board proposed essentially a wind down with the option to roll over into an equivalent open-ended fund. And the reason that this was possible to continue on the same strategy in an OIC was that essentially there was the view that Smithson wasn't making the most of these structural advantages that the investment trust has. It wasn't kind of utilizing gearing or things like that.
Yeah.
Of course, SAB have been on the register there at Smithson, and I suppose that these discounts that have kind of, deviled the sector. Is there an argument that SAB was actually doing investors a service?
So I mean, so the first thing I'd say on that is that discounts aren't necessarily a bad thing inherently. If you buy an investment trust at a 10% discount, the NAV and the share price goes up by 100%, and you exit on a 10% discount, that's still a pretty good outcome. But activism has always been a feature of the investment trust sector because of the discount aspect, with activists essentially seeing this as an arbitrage opportunity. In general, I think activism can be a positive for the sector. It can help concentrate boards' minds on acting in the best interests of shareholders, ensuring that an entrenched discount doesn't indicate some sort of structural lack of demand. But I think a key issue with activism is that there's a difference in the time horizons of activist investors who generally want to just make some quick money from narrowing that discount and exiting versus longer term shareholders. As I said at the beginning, that the investment trust structure is perfect for long term
I mean,
investment
it's interesting, and Saba's also recently taken a stake in Allianz Technology Trust. It's a
Yeah.
fund I know very well, and I have a personal interest in that fund. Its performance has been nothing short of outstanding over a 10-year period or longer. It does seem to me rather controversial for Saba to take a stake with the potential to rattle the cage when their performance has been so good. And realistically, the manager has limitations on what they can do about the discount. It's a market decision, isn't it?
Yeah, completely. And then, yeah, exactly. I agree. I think Saba in particular, in contrast to other activist investors we've seen in the sector, is how widely they are investing. And that has raised questions over their true intention. Essentially with people speculating that their true intention is to just gain management of and kind of.
Yeah, I suppose you might argue, because you've mentioned about the sort of short-termist nature of potentially Saba's objectives, and that tallies in with discount averages at the moment. We're looking at 12 to 14% according to data I've seen, and longer term averages are maybe high single digits. So do you think that's part and parcel of why Saba have really become active in the last 18 months to 2 years? Is they see this average discount as just simply being too wide relative to historical averages?
Yes, I think so. We saw Saba enter the investment trust market, as you say, kind of 2-3 years ago, and that's when we saw a real sharp discount widening across the investment trust sector, particularly in alternative assets or other interest rate sensitive asset classes. Essentially, it's when we started to get inflation post-COVID and interest rate rises. We saw a real sell-off in the investment trust sector, and that's when Saba came in to try and exploit that discount opportunity.
Yeah, where do your team see perhaps the most scope for re-rating potential across the trust sector, Emma? Would alternatives be one of those spaces?
Yeah, I think alternatives, I'd say particularly private equity. In the property space, we've seen quite a lot of sector consolidation and wind downs, and discounts have narrowed there. I think private equity, there's still quite a lot of scope for re-rating. Yeah, kind of across the overall investment trust sector, you definitely see the widest discounts in alternatives, so infrastructure as well. Right. I think private equity has probably more scope for narrowing, potentially as we start seeing more IPOs coming through, and that benefiting the underlying NAV performance of these private equity investment trusts, that should hopefully start restoring some confidence in valuations and see some discount narrowing.
Sorry, I'm on that topic. I mean, it strikes me. I'm thinking of Scottish Mortgage in particular. I mean, they've got a deep expertise in the private equity world, and I do think it needs some real specialist knowledge. It's not for every investment trust, the private equity space. But at the same time, there's been a real reluctance from the private equity private companies to list, and so you're not seeing that the valuation quite as clearly, perhaps, as some investors might like. What do you think about the pace of IPOs in general?
Yeah, I think it has been disappointing to an extent. It almost seems that every catalyst that we think is going to happen to help improve the listed markets and encourage more IPOs seems to just come and go without anything happening. There's always the promise of the IPO market's going to reopen. But we are starting to see some more positive signs, particularly, as you mentioned, Scottish Mortgage. SpaceX has been in the media. So SpaceX is one of Scottish Mortgage's largest holdings. That's been in the media.
It just makes you wonder. I mean, we've heard rumours as well about Anthropic possibly, and who knows? But we've had these stories circulating for quite some time, albeit with maybe different companies, and they just seem to pull the plug at the last minute because volatility in markets goes a bit crazy, etc., etc. It's just a long game. On that basis, then, I mean, across the wider investment trust space, therefore, do you think that even though if you might feel that a discount is too deep, most managers will argue that case, is therefore buying back shares a genuine value add to investors, or do you think they could apply that capital to actually taking bigger stakes in companies? Isn't that the real purpose of the capital?
It's a good question, and it's a kind of ongoing debate across the investment trust industry about whether buybacks work. And I think kind of to answer that question is what do you mean by working? I think as the evidence of the last few years would show that buybacks alone don't narrow discounts, but what they can do is they enhance the NAV per share for investors. That has a bigger benefit at wider discounts. So buying back shares at very wide discounts is accretive to the NAV. It can also help demonstrate the board's confidence in the portfolio. That's particularly relevant for alternative or private assets where there isn't a listed valuation. It can demonstrate that the board is comfortable with the NAV and therefore the true discount. And even though it might not narrow discounts, it can dampen discount volatility, help to mitigate that. But yeah, it does depend on the level of the discount and what the other options are. So essentially, whether it's a good capital allocation decision, it needs to be weighed against.
I suppose it's always going to be subjective, isn't it? I mean, we see it in the corporate world as well. I mean, it's been a timeless almost debate around share buybacks versus dividends, for example. What is the best? I suppose it comes down to your own personal point of view and the investment trust manager's point of view.
Yeah, and the board as well. I think that's, as I said, a key advantage of the structure is that obviously you don't need buybacks in open-ended funds, but the board has the ability to engage with shareholders. And kind of within the private equity space, as I was saying earlier, we've seen kind of more buybacks or official capital allocation policies there that boards have introduced after discussing with their shareholders what would you like to see? Would you like us to do buybacks, or would you prefer a dividend, or would you prefer us to reinvest? Yes, I think it depends on a case-by-case basis, but there needs to be shareholder engagement to see what the investors want.
Yeah. Is there an optimal number of holdings for a trust? Perhaps an equity trust is like 100 plus too many for an active fund, or is it really a case?
It's a good question.
Yeah.
I don't think there's an optimal number. I'd say that the closed-end nature of the investment trust does lend itself to running a more concentrated portfolio, because you can take that longer-term view. And we definitely see some funds take advantage of that. So, for example, Finsbury Growth and Income, I think that has 21 holdings, runs a very concentrated portfolio, and it's more concentrated than its open-ended equivalent, because it can use the closed-end nature. We also, there's a number in the UK smaller company sector like Addition Investment Trust and Rockwood Strategic. They both have kind of high teens, low 20s holdings, and they take quite big stakes in the underlying in their portfolio companies and engage with the boards and management and influence them. So I think running a concentrated portfolio is well suited to the investment trust structure, but then we also see other funds running portfolios of kind of 120 plus holdings, but still utilizing the structure in other ways, through gearing or allocation to small caps. So I think it depends what the investor wants. A concentrated portfolio is probably more likely to have more volatile performance, more influenced by the events at individual stocks, rather than broader market conditions. So
So interesting, because I think a good example, the two funds I mentioned, Allianz Technology Trust earlier, also Polar Capital Technology Trust. Again, I'm also a shareholder in that. And when I've spoken to the two separate managers, Ben Rogoff and Mike Seidenberg, and the way they perceive it is Mike wants to run a much more concentrated portfolio of around 35, 40 stocks, whereas Ben, to use his terminology, he calls his fund benchmark aware. So he wants to represent a much wider pool of investments, and maybe just look to over allocate or under allocate relative to the benchmark, rather than just picking and choosing individual stocks. We'll have those, we won't have those. So it's a different process, and investors need to understand that nitty gritty to know what they're actually getting, which is crucial, therefore, that the investment managers have forums like this to be able to get their messaging out correctly.
Yeah, definitely. And I think that, as you mentioned, the benchmark aware or thing is very relevant. It depends what you're looking for as an investor. If you want a portfolio that's maybe going to slightly outperform the index, then you want a more diversified portfolio. But it's on the flip side, it's unlikely to outperform by 100% in a year,
Sure,
whereas a more
sure,
portfolio could.
sure.
Yeah.
Well, I think that we'll call that a wrap there, Emma. That was a marvellous talking to you. Very fascinating conversation. Thank you very much.
Thanks, Emma.
Join us again, listeners. Tune in. We'll have a podcast later in the week. And until then, see you later. Cheerio.
Thank you.